Hi everyone. I work with a guy some of you will be familiar with, Raoul Pal, as he presented here last year, and couldn't be here this time, so I stepped in. And together, what we write is a macro research subscription service called Global Macro Investor, which goes out to the world's largest hedge funds, family offices, high net worth individuals, institutional investors, and so on. And what I'm going to be talking about today is something we came up with several years ago called the Everything Code, which explains the current backdrop as to why global central banks are all debasing their currencies, something I'll talk about a bit more, to offset essentially bad demographics and high debt levels, which then has shaped a business cycle landscape that warrants a very specific asset allocation. Now, you probably have two questions. The first question is, where is Raoul? Well, he couldn't be here this time, as I said, so I stepped in. So what does that mean for you? You're just stuck with the younger, better-looking version of Raoul Pal. And two, because he was talking about the Everything Code last time, why are we talking about it again? Well, it's because it's that important. So if you've seen this presentation before, I still think it's worth your time. There's, big picture concepts, something that might click this time that didn't click last time. And then if you haven't seen this presentation, I'm going to go as far as to argue that this is probably one of the most important 25 minutes you're going to extract from this conference in terms of content to put in a bottle and ship to your future self in a message in a bottle. Okay, now this is a much, much longer presentation generally, as you can see on the bottom. As you can't see, I'm clicking my laptop. As you can see on the bottom there, we did an hour-and-a-half presentation recently on YouTube, free to everybody. I have now 23 minutes remaining to get through 50 or so charts, which I can't. If you know who I am, you know I can probably do it. So we'll do our best to do that. But if you have time in the next couple of weeks to sit down and spare an hour and a half listening to two dudes talk macro, this is definitely worth your time. So the first thing I want to talk about is, or something to bring to your attention, is the fact that diversification is dead. Now, what do I mean by that? Well, the first thing we have to introduce is our GMI Total Liquidity Index. Now, this composites both public and private sources of liquidity. And in simple terms, what I'm just going to say is this is a combination of central bank balance sheets plus the global money supply, so global M2, aggregated together. And the line going up like this and annualizing at 8% represents debasement. Okay? Now, what is debasement? Debasement equals the invisible loss that comes with central banks basically printing money, right? Expanding their balance sheet. And that weakens the currency in all financial contexts because it increases the supply, right? So that's one thing to understand. And it's not to confuse with inflation, because inflation, debasement creates asset price inflation. Inflation is the rise that you're seeing in your grocery store bills over time, which I think is something that we can both agree is really accelerated over the last couple of years. But what this means, all of a sudden, is that you have an 8% invisible loss to your purchasing power every year. And then you have a visible, let's call it 2% rise in inflation, which means that things are just getting more expensive. And together, you put them together, you have a 10% hurdle rate on your investments. Okay, so real terms is 8%, nominal terms is 10%. So what that means, in a nutshell, is that if you are not making 10% on your investments, your future self is poor. Okay, so now that I have your attention, let's talk about the Everything Code. So in order to understand the Everything Code, the first thing to talk about is the magic formula. GDP growth equals population growth plus productivity growth plus debt growth. And GDP growth has been in decline over time, okay? And currently it's running at around, the trend rate is running at around 2%. The working age population, so demographics have been in decline, okay? Productivity has been in decline. The only thing that's gone up is debt, okay? Now, this can be broken into two buckets. So here's private sector debt as a percent of GDP, and it's moved basically down from 140% during the global financial crisis to 120% today. But what most people don't understand is that this was a forced deleveraging driven by the banks as they tightened credit standards to households, essentially making credit more difficult to get a hold of. But the issue here is that this debt cannot just disappear. So what's happened is that, guess what? The public sector has taken on this debt. So the public sector has jumped from 100 to 120% of GDP in debt. Now, the issue here, and this is where the problems start, is that if the private sector is over 100% of GDP in debt, and as is the public sector, that means that and let's just assume interest rates are at 2%. They're not, they're double that. But let's just say it's at 2%, and the trend rate of GDP is at 2%. That means 100% of GDP is going towards servicing private sector debts, which is an unproductive source of GDP. So then you're going to say, okay, well, what about the government debt? Well, to get to that, I'm going to move these. First, we got to talk about demographics, our destiny. Okay. So birth rates peaked in the 1950s and have been in decline. And this is actually really interesting because what happened, just as a side note, post-World War II, is everybody came home from the war and actually wanted to make love, not war. And that big spike in birth rates, accelerated by 20 years, is what drove the 1970s wave of inflation. Okay? But now this is in decline, so that's a separate issue, but I just think it's interesting to think about. And here we are, if we take US birth rates and you advance it versus the labor force participation rate by 16 years, again, why 16 years? Because people are then coming into the labor force. This suggests that the labor force participation rate is going to come down more over time, and this is only obviously going to be accelerated by things like AI and robotics. The way to think about AI is it's the infinite scaling of human knowledge, and robotics is the infinite scaling of human physical labor. So over time, the labor force participation rate will go down. Now, here's arguably one of two of the most important charts in macro today shaping this landscape that very few people understand, and Raul and I always make jokes about this because no one's copying it yet. Essentially, government debt growth is offsetting the entire demographic decline. Because if GDP growth is debt growth plus population growth plus productivity growth, and those two, and population growth and productivity growth are in decline, then debt offsets that growth, and that's what's happening here. Now, but what happens to all this debt? Well, all debt growth in excess of GDP gets monetized by the central banks. And this isn't just the US. This is a US presentation. This is happening here. We've run the numbers. This is happening in Japan. It's happening in China. This is a globalized thing, okay? So basically what's going on here is that magic money has been paying the interest on all this debt since 2008. And more importantly, that governments are issuing new debt to service the interest on their existing debts, which at the end of the business cycle gets thrown on the balance sheet. And the really, really big picture here is just that there is still a vast amount of interest payments which need to get monetized, which have far, far exceeded GDP growth. So next thing we need to talk about, and then I'll bring this towards what it means for your portfolios, that everything since 2008 has become cyclical. And this is what's created, sorry for these incredibly bright colors, this is what we call the Bitcoin seasons, of course. But it's created this 4-year boom-bust cycle in assets. It's not just crypto, it's also equities, it's credit, it's commodities, right? It's the business cycle. And what's been driving this is the term structure of public debt. Okay, and basically what happened in 2008 when interest rates fell to zero, all major governments reset their debt between 3 and 5 years. And that creates a weighted average maturity of around 4 years, which is then driving this business cycle. Okay, because 70% of the term structure is less than 5 years. Now, this worked until it didn't. Now, why did it stop working? Because post-COVID, the Treasury had been running something called maturity extension programs, whereby issuing less at the front end, when I say the front end, I mean notes, issuing more bond or bills, and all of a sudden, if you look at the term distribution today, it's a 5.4-year cycle, right, based on the weighted average maturity of this debt. So this is a big part of why we believe the business cycle extends. The 4-year cycle is dead, and this business cycle extends into 2026. And we also know a comment that was mentioned earlier about the Fed cutting rates. A part of why the business cycle has been held back is largely just a function of rates being too high for too long. But now, if we're setting up in an environment where rates are to come lower, the business cycle should move higher. Now, why is this important to us as investors? Because Bitcoin is a macro asset. Now, this is Bitcoin in its log regression channel. And when I first joined RAL, I had been managing multi-asset portfolios for a number of years, and I was very familiar with asset allocation across FX, commodities, bonds, equities, regionally, sectorally, you name it. And I was looking at, but in order for me to make sense of Bitcoin, I had to make sense of it within a macro context, and that was hard initially. But then I was looking at this chart, and you can kind of see we get to +2 standard deviations overbought. You know, we come down to the middle end of the range. We dip slightly below that, but it looked like a business cycle. So guess what happened when I detrended this? Oh, it is the business cycle. And by the way, for those of you that are not familiar with the ISM, it's what Raul and I think is the best proxy, business cycle proxy. It stands for the Institute of Supply Management. They have them for every country on the planet. They're called PMIs. But what this does is it's asking supply chain executives how they feel about their business, employment, new orders, CapEx intentions. And so essentially, when this is rising, the business cycle is accelerating, and when it's falling or declining, it means the business cycle is slowing. So we bottomed in March of 2023 and have been sort of muddling along here as a function of rates. But the point is that this is a really important breakthrough, because what I had realized at this point up until then, I had heard that Bitcoin was this kind of schizophrenic asset class which bears no resemblance to the real economy and therefore is not governed by the same economic fundamentals as, say, an equity risk premium or a credit spread. That's all wrong. It is. It's the same thing. It's the same thing that's driving the S&P 500, small caps, so the Russell 2000, cyclicals versus defensives, crude oil prices, industrial metal prices. And here's just another way of looking at that. This is why the business cycle is such an important factor, is that once the business cycle bottoms and starts to head towards its late cycle peak somewhere around 60, and when I say business cycle, I'm using that synonymously with the ISM, you can see that start of that black line, and then as it accelerates towards the peak is when the really, really big moves come, right? And this also explains ETH BTC, right, in the sense that as the business cycle accelerates, block space usage is a function of economic activity. So as the economy, as economic activity picks up, as earnings pick up, demand for block space increases. The opposite is also true, which is Bitcoin is by no means a safe haven, but people come closer into the risk curve, which is why, guess what? Bitcoin dominance is also just a function of the business cycle, despite all the stories and narratives you hear out there. And the reason that this works is because, again, from a very high-level asset allocation perspective, when the business cycle is accelerating, you tend to prefer small cap equities, let's say, versus large cap equities, or value versus growth, or cyclicals versus defensives, or cyclical commodities as opposed to defensive commodities, you know, whatever that is. But that value rotation as the business cycle picks up also plays out in crypto in what we call a crypto risk curve. So essentially what's happening is once people get orange pilled, which is essentially the gateway drug to crypto, when people start to see other tokens go up, whether that be in the top 10 or whatever it is, you can't really help yourself once you have a wallet set up to buy a little bit of Doge or whatever it is that you fancy. But that's what drives this Bitcoin dominance. And the good news is that our lead indicators, that we talk about, our interest rate model says that the ISM will continue to accelerate, as does our GMI Financial Conditions Index. Now, this is a regression on commodity prices, interest rates, and the dollar. So here it's advanced by 9 months. And very simply, if you just look at the percentage of central banks cutting rates, and you advance it by 9 months versus the ISM, bar discussions around tariffs and all the other noise out there, the only thing that would really be talked about is this global coordinated easing cycle, which is a huge favorable tailwind for the business cycle looking out 9 months. Once again, why we think this 4-year cycle is finished and we have more returns next year. Now, Bitcoin is also a network value asset. So time is adoption. So you could think about that as Metcalfe's law, right? So the more people who join the network, the more valuable the network becomes. And the rate of adoption is the business cycle as driven by earnings, sentiment, and everything else that comes with a business cycle that's heating up, okay? And so here we are again with this log regression channel. And if I start to put targets here, this is why time is important. Because if we just let time come into the equation, Bitcoin should end the year between 210,000 to 100,000, meaning we somewhere between that -1 fair value log regression channel. But then, let's say all of a sudden we have an ISM. I'm going to flip forward for a second, come back, because now all of a sudden, if I've detrended that log regression channel, I can now loosely infer levels of the ISM required to achieve certain Bitcoin targets. So now if all of a sudden, if we come back here, I know that if we can get to 412,000 Bitcoin by year end, sounds high, right? But what's required for that to happen? The business cycle has to A, extend until year end, which it will, but then we also need an ISM of 57.6 by then, or around abouts there. If all of a sudden Bitcoin was to go to 800,000, that green's very hard to read, but it says 805,000, we would need an ISM of 63 or higher, okay? That's not gonna happen, right? But then if you start to extend this out a little bit, this is where, again, adoption is interesting, especially in combination with what I presented before in terms of the business cycle picking up further next year, is if we just end next year with the ISM basically where it is, although just a little bit higher, we're already at 370,000 or so. So let's just take that 730,000 thing, and a target, and then we'll move on. What's required, once again, for 730,000 Bitcoin by year end of next year? A, the business cycle to extend into December 31st of next year. B, an ISM of around 58, or a global PMI, however you want to think about that. But that's essentially the framework, right? Because once again, this logarithmic adoption trend is a detrended Bitcoin price, which is why adoption is just time, but then the size of the move is driven by sentiment, earnings, as I say, everything that comes along with the business cycle. All right, the supermassive black hole. I got 8 minutes. Let's do it. Here we are with this again. This 8% real hurdle rate for your investments, 10% in nominal terms. What's the best hedge? Well, tech stocks, Bitcoin. But in order to really understand the value here, you have to put it in a scatter chart, and understand that Bitcoin our GMI total liquidity composite explains around 96% of the variability in tech stock price movements, and around 90% of that in Bitcoin, okay? So what's important here is that tech stocks have actually outperformed our GMI total liquidity composite by 14% per year since 2012, right? So that's you accumulating purchasing power. You're not losing purchasing power. But Bitcoin, so I've got 2 time frames here. The first one the bottom one is since inception, essentially. So the annualized return has been around 140%. But if we just compare it versus the NASDAQ, versus at the beginning of 2012, you look at an annualized return of around 94%. Okay, so it's big. And this goes to my point here. Now, this is an asset allocation table to my point that diversification is dead. You've got commodities, you've got gold, you've got EM stocks, EM bonds, investment grade bonds. All of these I used to invest in. But if your nominal hurdle rate is 10%, if you look at that red box, that's the annualized return since 2011, you're not making any money. You're losing money. And this is really important because these things, if you're going to say, but Julien, my large cap equity fund at Goldman, it's making 6% per year. Yeah, you're still losing money. You're making money, but you're not getting any richer. Does that make sense? That's important. And gold's the same thing. But then, as I said, real is 8, nominal is 10. It can be higher depending on where you are. Let's just say inflation's 3, it's 11, but sometimes it's higher. Even large cap equities, are pretty much break even. So that means that the only two assets that are really accumulating purchasing power and actually making you richer are things like tech stocks and crypto. Okay, but now check this out. Here's the NASDAQ 100, including dividends, versus the Bitcoin since 2012. It's down 99.93%, okay, which is pretty staggering to think about. Now, this is the last chart I'm going to talk about. Just about right. We've got about 5 minutes. Oh, that's not supposed to look like that. That's weird. Okay, but anyway, these are all boxes which show the market cap of global debt, global real estate, global equities would be that bottom gray box. Sorry, I'm just going to come down here because it's a little bit confusing. And then here, that's Bitcoin. This would be gold. So gold's at around 30 trillion. And so this is that entire space, right? Bitcoin's the orange box, and then crypto overall is those two. But we know that collectively that's about 4 trillion. And so what Raoul and I believe at Global Macro Investor is that we're still very early in the early stages of a global race to accumulate as much Bitcoin as possible, driven by institutions, sovereigns, and individuals. And you know, Raoul was in UAE. I think that's come up before earlier. UAE a couple of months ago, and it's meeting with some of the larger sovereign wealth funds, and it's very clear there that the ruling leaders have been given a directive to focus almost entirely on crypto and AI, right? And this is across, you know, Dubai, Qatar, Bahrain, Saudi, right? And the mandate is recycle all of your fossil fuel profits and put it directly into the future financial system. And so in our view, this is going to be the driving force that takes this space from 4 trillion to 100 trillion over the next 10 years, okay? And if we're right about this, because it's not just the Middle East, I can tell you that. We have discussions all over the world about stuff like this, and everybody's pivoting. But some take more time than others, but everybody's kind of coming on board. If we're right about this, this will be the single greatest wealth creation opportunity any of us have been given in our lifetime, and it'll go down as the single greatest macro trade of all time, right? So this is the Everything Code. Thank you. I hope that I've given you something to think about. So yeah, thank you.